Welcome to Session 7, Emerging Trends in Financial Management. In today's dynamic global environment, financial management is continuously evolving, shaped by rapid change, as well as technological advancements, including complex geopolitical shifts, and, significantly, fundamental demographic transformations. This session aims to equip you with the foresight and analytical tools necessary to navigate these forces. We will delve into three pivotal areas, starting from sustainable finance and green investments, following by globalization and financial strategies, and finally, we need to have full understanding over the disruptive power of digital transformation. After we are having an idea of dynamic global environment of financial management evolving, we, therefore, would like to bring you the evolving financial landscape and pivotal areas to your attention. Particularly that should consist of financial management in a dynamic era, and the focus of redefining financial management. Basically, we aim to provide the conceptual frameworks of foresight and analytical tools to navigate today's and tomorrow's dynamic financial environments further. Our agenda for Session 7 is structured around these key emerging trends. First, we'll explore sustainable finance and green investments, discussing the growing importance and specific instruments, like green bonds and renewable energy investments. Next, we'll examine globalization and financial strategies, focusing on its impact on decision-making and how to manage cross-border investments and trade finance. Finally, we'll analyze the digital transformation through compelling case studies, which we will manage to have the practical workshops for this section in the classroom. Let's now dive into our first key emerging trend, sustainable finance and green investments. This area represents a profound shift in financial markets, where environmental, social, and governance factors are increasingly integrated into investment decisions. We'll explore why this is becoming so critical and then look at the specific financial instruments driving this transformation in the next segment. We start this session with sustainable finance and green investments. Sustainable finance represents a paradigm shift by integrating environmental, as well as social, and together with good governance. We call these phenomenon as ESG. With this new paradigm, ESG would have been factored into financial decisions or any related financial considerations. Upon the goal is to create long-term value for shareholders, society, and the earth. Its growing importance is driven by factors such as risk management, regulatory pressure, investor demand, and the evolution of fiduciary duty. We, therefore, have to focus on both greening finance to deliver making traditional finance sustainable, as well as financing green for channeling capital towards sustainable activities. In order to achieve sustainability goals, innovative financial instruments are crucial. We strongly recommend you to keep your eyes on the following financial instruments for your future business benefits. Let's start with green bonds. Green bonds are fixed income instruments specifically designed to fund climate and environmental projects. You may need to take this instrument to be under your consideration if your business projects are involving with climate and environmental concerns. We continue to have an idea for the benefits from carbon credits. Carbon credits represent verifiable reductions in greenhouse gas emissions and are traded in carbon markets. A cornerstone of green investments is renewable energy, with projects often financed through structures like project finance, equity investments, or specialized green funds. This is another opportunity for your new funding sources. These instruments mobilize capital for a sustainable future, offering both financial returns and positive environmental impact. Globalization has profoundly reshaped financial management, introducing both vast opportunities and complex challenges for financial decision-making. It demands sophisticated, integrated approaches where international factors become central to strategic planning. Globalization is fundamentally reshaping financial management. It profoundly alters how financial decisions are made, introducing both vast opportunities and complex challenges that financial professionals must navigate. There are about 6 major impacts of globalization on financial decision-making, which we will delve into in detail on the following slide. These include elements like increased market opportunities, enhanced competition, currency risk, political and economic instability, regulatory complexities, and capital mobility. Ultimately, globalization demands sophisticated, integrated financial management. It requires that international factors are no longer external considerations, but rather an integral part of strategic planning for any business operating in this interconnected world. Now, let's look at the key impacts of globalization on how financial decisions are made. First, while globalization presents increased market access and opportunities for businesses to reach new customers and optimize supply chains, it simultaneously brings enhanced competition. Companies face rivals from across the globe, demanding greater financial agility and efficiency to maintain the competitive edge. Second, operating across borders introduces significant currency risk. Fluctuations in exchange rates can directly impact a company's revenues and costs, and alter the value of foreign assets and liabilities, making currency hedging a critical financial consideration. Third, financial managers must skillfully navigate political and economic instability. Different countries present varying levels of political, economic, and regulatory stability, necessitating careful assessment of geopolitical risks, sovereign risk, and the potential for sudden policy changes or economic downturns in foreign markets. Fourth, businesses encounter complex and diverse regulatory and legal frameworks. Adhering to varying tax regimes, accounting standards, and financial regulations across multiple jurisdictions becomes a substantial financial and operational challenge. Fifth, while capital mobility offers broader access to funding sources globally, it also exposes firms to increased global market volatility. This means financial strategies must account for rapid shifts in international capital flows. Finally, ensuring supply chain resilience has become paramount. Global interdependencies, while efficient, can make supply chains vulnerable to disruptions like pandemics or trade disputes, requiring robust financial planning to ensure continuity and mitigate operational risks. These factors underscore how deeply integrated global considerations now are in every strategic financial decision. Managing financial strategies in a globalized world involves specific approaches for both key aspects. which are cross-border investments, and following with trade finance. At the cross-border investments standpoint, this includes carefully structuring foreign direct investments and diversified portfolio investments, alongside robust risk management strategies for currency and political risks. On other hand, trade finance instruments, like letters of credit, are essential for facilitating international commerce and mitigating associated risks that we are not able to look over if we are running cross-countries business. For cross-border investments, we may need to properly define the risk and management's concerns over the following three aspects. Considering the foreign direct investments, this approach requires careful capital budgeting, optimal financing mixes, and profit repatriation strategies. For portfolio investments, we got to focus on diversification benefits, currency hedging, and regulatory compliance. Moreover, risk management extends to hedging strategies for currency risk, political risk insurance, and international tax planning. In trade finance, various instruments such as letters of credit, documentary collections, and support from export credit agencies are vital for ensuring confident engagement in international trade and managing its unique challenges. Beyond direct investments, trade finance plays a critical role. These are financial instruments specifically designed to facilitate international commerce and effectively mitigate the inherent risks in cross-border transactions, such as non-payment by buyers or non-delivery by sellers. Key examples include letters of credit, or LCs. These provide a bank's guarantee on behalf of the buyer to pay the seller, contingent on the seller meeting specified conditions, significantly reducing payment risk for exporters. Documentary collections. Here, banks act as intermediaries to collect payment against the presentation of shipping documents, offering a simpler, though less secure, alternative to LCs. Export credit agencies, or ECAs. These are government-backed institutions that provide insurance, guarantees, and even direct financing to support domestic companies' exports, especially for large-scale projects. And supply chain finance solutions like factoring and forwarding. Factoring involves a business selling its accounts receivable to a third party at a discount for immediate cash, while forwarding is the purchase of trade receivables, typically without recourse. Both optimize working capital across the supply chain, improving liquidity for businesses involved in global trade. Ultimately, these trade finance mechanisms are absolutely essential for businesses to engage confidently in international commerce and effectively manage the unique financial challenges that arise when operating across borders. Digital transformation is fundamentally reshaping industries and financial services. We will explore its disruptive power through compelling case studies. Please note, the in-depth analysis of these digital transformation case studies will be an in-depth practicum in the classroom, allowing for practical application and deeper understanding of their financial strategies and market impact. In conclusion, the financial landscape is in a perpetual state of flux, driven by the profound influences of sustainable finance, globalization, and digital transformation. These megatrends demand a holistic perspective in financial management. Success hinges on effectively managing financial risks in a global context, leveraging digital tools for innovation and efficiency, and aligning all financial strategies with broader sustainability goals. By